if we had a circumstance, particularly in the US, where we had a liquidity crisis, if there was a black swan, a 2008 style event, and I could think of two or three black swans that might cause it, then the Fed would certainly step in with quantitative measures like they have before.
Okay.
I'm not saying we're going to have a black swan, by the way, but if we did, it would really truly be off to the races.
Today, we delve into a compelling perspective shared by Rick Rule, a seasoned financial mind. Rick emphasizes a potential black swan crisis in the US economy, supported by historical data and his unique insights. Drawing on his discussions with lower-level Fed officials, he highlights a scenario where the Fed might consider a pivot, recalling a pivotal moment in 1976 that ignited a remarkable gold rally. But what truly caught our attention is Rick's macro comment on a possible liquidity crisis, echoing a sentiment of caution. He points to the US corporate junk debt market as a potential culprit, expressing concerns about the illiquid nature of assets held by high-yield ETFs. These ETFs, widely owned by retail investors, face challenges if credit concerns trigger a run, forcing them to sell underlying illiquid bonds. Rick Rule, not one to predict doomsday scenarios, nevertheless warns of a landscape that gives him pause. While he acknowledges the uncertainty, he focuses on the potential fragility of the junk bond market structure, akin to the circumstances that led to the 2008 financial crisis.
I know that the Fed regards themselves as the last bastion of defense against inflation. The idea that Congress might exert some discipline, or that either Trump or Biden might exert some discipline, is fine fiction. We're regulated by the Fed, so we talk to lower-level Fed people all the time. And I think their preference would be to talk about lowering interest rates to unseize certain parts of the economy, but keep the interest rates firm. If they don't, if they pivot, if the reaction in the U.S. economy to the rises that we've seen gets worse, in other words, if the pain from the punch last year is delayed, then they will lower interest rates. And if they lower interest rates, I remember in 1976, that Fed pivot. And that Fed pivot kicked off the damnedest gold rally of my career.
Wow.
I'm not saying it's going to happen, but the only good thing probably about being 70 years old is that while history doesn't repeat, it often rhymes. And I remember that circumstance, believe me, like it was yesterday. And I remember it with a certain fondness. And if we saw a substantial Fed pivot, gold would be off to the races. What other comment, macro comment? I'm no economist. I'm a credit analyst. I'm a used money salesman. But if we had a circumstance, particularly in the US, where we had a liquidity crisis, if there was a black swan, a 2008 style event, and I could think of two or three black swans that might cause it, then the Fed would certainly step in with quantitative measures like they have before.
Okay.
I'm not saying we're going to have a black swan, by the way, but if we did, it would really truly be off to the races. And when I look at the horizon, again, not as an economist, but rather as a credit analyst, I see one potential culprit. And that culprit is U.S. corporate junk debt.
Oh.
People, when I say people, corporations have been borrowing on very generous credit terms for 40 years now.
Yeah.
And these junk bonds are frequently bought by high-yield ETFs. The ETFs are owned by retail investors who haven't done any securities analysis. We call them inelegantly yield whores. And while the underlying ETFs are extremely liquid, the assets that they hold are very illiquid. And if you had a situation where there began to be credit concerns in the United States, and there should be, and you began to have disintermediation, which is to say, if retail investors began to sell the highly liquid ETFs, the ETF manager would have to sell the underlying illiquid bonds. There was a saying when Drexel Burnham came apart, the last time the junk bond market came apart.
Yes.
They had this phrase called an owl bond. An owl bond is when the customer calls the broker and says sell, and the broker says, woohoo. So if I looked at something at the landscape that scares me,
Yeah.
it's credit concern in the junk bond market and a run on the banks. By the banks, I mean the ETFs, which hold $2 or $3 trillion worth of junk bonds
Really?
that are completely illiquid. These
Wow.
ETFs trade like water, and some of the underlying junk that they hold trades every 6 weeks. They're over-the-counter bonds. And I'm not saying this is going to happen. Believe me, I have no idea it's going to happen. But I've been pounding my brain trying to think about what could go wrong
Yeah. Yeah.
with various theses that I have. And what could go wrong would be a credit circumstance like 2008. And when I think about what could precipitate that, other than, say, a broader war, the one that comes most easily to mind is the structure of the junk bond market.
Okay.
And I will admit that scares me.
In this next discussion, Rick points out a significant shift since the 2008 real estate securities collapse. Back then, federal government liabilities were 30% of GDP, but today they stand at 10% of GDP. This prompts Rick to question how much room the Fed has left to maneuver in case of another crisis. Now, why is Rick Rule holding on to gold and cash? He emphasizes the potential damage that could occur during the interim of a crisis, despite his belief that the Fed could ultimately intervene. In a defensive move, Rick strategically allocates a substantial portion of his portfolio to cash, even though it yields less than the real rate of inflation. He sees negative interest as an option premium, offering liquidity to capitalize on an illiquidity squeeze. Rick's caution extends to gold, which he regards as the ultimate form of cash. At 70, with a diverse portfolio ranging from low-risk investments to high-risk opportunities, Rick Rule finds solace in the balance of gold and cash, providing both security and peace of mind.
Well, we certainly were able to recover after the 2008 real estate securities collapse. It's important to note, though, that the Fed did that in a circumstance where aggregate on-balance sheet federal government liabilities were 30% of GDP. They're now 110% of GDP.
Yeah. Yeah.
One wonders how much string is left to push. I'm not saying that there isn't enough faith in the U.S. Fed and in the U.S. economy that they couldn't save it again. I actually think they could, but I think the damage that would be done in the interim would be substantial. And I think that the damage that would be done to the psyche of investors like your listeners while they work that out would be massive. In my own portfolios, I've told you before, I have a lot of cash.
Yeah.
And I have that despite the fact that the interest I get paid on my cash is, I believe, less than the real rate of inflation. In other words, I'm losing money on my cash.
Yeah.
I'm doing that because I regard that negative interest as a premium, as an option premium on having the cash to take advantage of a circumstance where an illiquidity squeeze happened. I hope when I hit whatever age I am that I become reflective and not aggressive. When I'm looking back at things, I think that my caution with regards to cash and my caution with regards to gold was ill-founded. I hope nothing goes wrong. I hope that my defensive investments turn out to be mistakes. But I got to tell you, I sleep better for having made them. That isn't the only thing. I've been around a long time. I've worked hard. I got lucky. I saved. I have a reasonable sized portfolio. So, and it's beginning to look really like a barbell. Very low risk investments like bullion, cash, senior companies like Exxon. Then in the middle, there's not much. And then I'm buying all these penny dreadfuls over here. So it's low risk, no risk, and high risk. So I'm probably stupid owning gold, as I say, because I'm a large Sprott shareholder. If gold does well, Sprott will do well. But gold helps me sleep nights. I consider it to be the ultimate form of cash. And at 70, it's rare that things help you sleep well. So I own gold and I own cash.
As we wrap up today's insightful discussion with Rick Rule, Let's recap the key points that could shape the future of the US economy. From the Federal Reserve's potential pivot to the looming concerns in the junk bond market, Rick Rule has painted a thought-provoking picture of the financial landscape. The prospect of a black swan event and the delicate balance of the Fed's response underscores the importance of staying informed and prepared in these uncertain times. Rick's strategic allocation to cash and gold serves as a reminder of the value of defensive investments. Now, before you go, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments below.